on October 24, 1929, as 12 million Americans watched their savings vanish inside a single trading session on the floor of the New York Stock Exchange. A confidential internal memo written 3 weeks earlier by a Federal Reserve Board member confirmed that the decision to hold interest rates and allow the banking system to consume itself had already been made in a closed room in Washington. That morning started like any other Thursday on Wall Street. Clerks arrived before 7. Ticker tape machines were oiled and loaded. Floor traders lit cigarettes and checked overnight cables from London. The Dow Jones Industrial Average had been climbing for most of the decade, and despite a few nervous weeks in early October, the consensus among brokers was that any correction would be temporary. America was prosperous. The economy was modern. The Federal Reserve, established just 16 years earlier specifically to prevent financial panics, was watching over everything. By noon, that consensus was gone. The ticker tape fell so far behind actual trading that investors on the floor had no idea what their stocks were actually worth. Sell orders piled up faster than they could be processed. Crowds gathered outside the exchange on Broad Street, not rioting, just standing, watching the building as if they could hear something from inside. Police were called. A man was seen on a ledge of a nearby building, and someone in the crowd shouted that he was going to jump. He was a window washer, but the fact that anyone believed it said everything about the mood of that hour. By the closing bell, nearly 13 million shares had changed hands. The phone lines into brokerage offices across the country were overwhelmed. In Chicago, in Boston, in Pittsburgh, ordinary people, teachers, factory workers, small business owners had borrowed money to buy stocks on margin. 10% down, 90% borrowed from their broker. As long as prices rose, the math worked. The moment prices fell past a certain point, brokers had the legal right to liquidate those positions without warning. That right was being exercised in real time on Black Thursday. What followed over the next 5 days became the most studied economic event in American history. Black Monday, Black Tuesday. The Dow lost nearly 25% of its value in less than a week. Billions of dollars in paper wealth disappeared. The newspapers ran photographs of traders slumped over their desks. The official story, assembled quickly in the days and weeks that followed, was almost universally the same. This was the consequence of irrational speculation. The market had been inflated beyond all reasonable valuation by reckless investors who borrowed too much and chased prices too high. What went up had to come down. No one caused this. No institution failed in its duty. It was, in the language of the time, a natural correction. That explanation would stand largely unchallenged for more than 3 decades. It was wrong, or at minimum, it was deeply incomplete, because what the official narrative omitted was a specific sequence of decisions made inside the Federal Reserve between 1928 and 1929 that Milton Friedman and Anna Schwartz would later describe with precise documentation as the direct cause of the depression that followed. Not the crash itself, markets crash. What followed the crash, the systematic destruction of the American banking system, was not inevitable. It was the result of a policy choice, and the men who made that choice knew, or should have known, what they were doing. But to understand how that happened, and why the public was never told, you have to go back 1 year earlier to the autumn of 1928, and to the death of a single man who had been the only person inside the Federal Reserve capable of preventing what came next. His name was Benjamin Strong. He was the governor of the Federal Reserve Bank of New York, and for 15 years he had been the most powerful central banker in the world. When Strong died of tuberculosis on October 16, 1928, exactly 1 year and 8 days before Black Thursday, he took with him the institutional memory, the political relationships, and the monetary philosophy that might have stopped the Depression before it began. What filled the vacuum after his death was something far more dangerous. A faction inside the Fed that believed with genuine conviction that a financial collapse was not a disaster to be prevented, but a medicine to be administered. That faction had a name for what they wanted. They called it liquidation. The official story of the Great Depression was assembled quickly, and it was assembled by the people who needed it most. In the weeks after Black Tuesday, the explanations came from familiar voices. Treasury Secretary Andrew Mellon held a press conference and told reporters that the market had been overextended by speculators. President Herbert Hoover issued a statement expressing confidence in the fundamental soundness of American business. The New York Times ran a front-page analysis attributing the crash to excessive optimism among retail investors who had no business buying stocks in the first place. The Federal Reserve said nothing of substance, which was itself a kind of statement. The narrative that took hold was clean and morally satisfying in a particular way. Ordinary people had gotten greedy. They had borrowed money they could not afford to invest in stocks they did not understand. The market had simply corrected back to rational valuations. Yes, it was painful, yes. People had lost money, but the system itself was sound. No institution had failed in its responsibility. What happened was the natural consequence of human excess. not a policy failure, and certainly not the result of decisions made in closed rooms by unelected officials who would never personally suffer for those decisions. This narrative served several interests simultaneously. It protected the Federal Reserve from scrutiny at the precise moment when scrutiny would have been most dangerous. The Fed was 16 years old in 1929. It had never faced a serious congressional investigation. Its internal deliberations were not public record. The minutes of its board meetings were not released. The specific policy decisions made in 1928 and 1929, the rate increases, the refusal to expand the money supply, the calculated passivity in the face of bank failures, were invisible to anyone outside the institution. It also shifted blame downward. If the crash was caused by reckless small investors, then the victims were also, in a meaningful sense, the perpetrators. The factory worker in Ohio who had put $50 into a brokerage account had only himself to blame. This framing was extraordinarily useful to the financial institutions and government officials who actually held power over the conditions that made the crash possible. And it created a historical record that would shape economic policy, academic research, and public understanding for a generation. By 1930, the story was settled enough that most newspapers stopped questioning it. Hoover continued to insist that recovery was imminent. The Federal Reserve continued to do very little. And the depression, the actual depression, the bank failures and the breadlines and the 25% unemployment was only just beginning. What the public did not know in 1930, and would not know in any formal documented way for another 30 years, was that the Federal Reserve had faced a clear choice in the months following the crash and had made a specific decision. That decision was to do nothing. This was not negligence in the passive sense, not a bureaucracy that was slow to respond, or officials who misread the data. The Federal Reserve in 1930 and 1931 received information about bank failures in real time. It watched as correspondent banking networks collapsed across the Midwest and South. It received reports of depositor runs spreading from one institution to the next. The mechanism was understood. When depositors feared their bank might fail, they withdrew their money in cash. That withdrawal reduced the bank's reserves. A bank with depleted reserves could not make loans. A bank that could not make loans could not survive another wave of withdrawals, and so it failed. When it failed, depositors at neighboring banks panicked and repeated the process. This was not a mystery. It was the exact scenario that the Federal Reserve had been created in 1913 to prevent. The standard intervention was straightforward. The Fed could provide emergency liquidity to solvent banks facing temporary runs, purchasing their assets or lending against them at the discount window. This was the lender last resort function, the core institutional purpose of a central bank, the reason Congress had authorized its existence, the reason it held powers that no private institution possessed. Between 1930 and 1933, the Federal Reserve largely declined to use that power. 9,000 banks failed, roughly half the banking institutions in the United States. Millions of Americans lost deposits that were not insured. There was no federal deposit insurance until 1933. Businesses could not get credit. Farms were foreclosed. Industrial production collapsed by nearly half. Unemployment reached 25% nationally, and in some industrial cities it was higher. The Fed watched. The official explanation offered at the time and for years afterward was that the situation was simply beyond the Fed's capacity to address. The problems were structural. The speculative excess of the 1920s had to be worked through. Intervention would only delay the inevitable adjustment. This language came directly from Andrew Mellon, who had served as Treasury Secretary under 3 presidents and who articulated what became known as the liquidationist position with unusual candor. Mellon reportedly told Hoover to liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, purge the rottenness out of the system. That quote would later become one of the most cited passages in Depression historiography, not because it was shocking, but because it was honest about what the policy actually was. Hoover himself, to his credit, found Mellon's advice repugnant. He wrote about it with evident disgust in his memoirs years later, but he also largely followed it. What the public did not know was that the liquidationist position was not simply a policy preference or an economic theory. It had beneficiaries. The process of liquidation, the forced sale of assets at collapsed prices, the transfer of property from insolvent debtors to cash-holding creditors, moved wealth in a specific direction. It moved wealth away from the millions of small borrowers, farmers, and business owners who held debt and toward the relatively small number of individuals and institutions that held cash or liquid assets going into the crisis. To understand who those people were and how some of them seemed to know what was coming before it arrived, you have to look at a set of transactions that occurred in the months before October 1929, transactions that, taken together, describe a pattern that the official narrative of blind collective panic cannot easily explain. Paul Warburg published his warning on March 9, 1929. It appeared in the annual report of the International Acceptance Bank, a document that circulated among financial professionals but rarely made front-page news. Warburg was not a household name to most Americans, but inside the institutions that actually governed the financial system, his name carried more weight than almost anyone else in the country. He had been one of the principal architects of the Federal Reserve Act of 1913. He had sat on the original Federal Reserve Board. He understood the mechanics of American monetary policy with a precision that few people alive could match. What he wrote in March 1929 was unambiguous. The current wave of unrestrained speculation, he argued, would bring about a general depression involving the entire country. He used the word depression. He specified that the speculation in stocks had reached levels that were disconnected from any rational assessment of business value. He called for the Federal Reserve to act immediately to restrain credit. And then, according to brokerage records that survive from this period, he proceeded to liquidate a substantial portion of his own equity holdings over the following months. The financial press noticed the public statement and largely dismissed it. Warburg was called a pessimist. One editorial accused him of trying to talk down the market for his own benefit, an accusation that, given what followed, carried a particular irony. By September 1929, Warburg had moved most of his personal portfolio into cash and short-term bonds. He was not alone. Bernard Baruch was one of the most prominent financiers in America, a man who had advised Woodrow Wilson during the First World War and who maintained close relationships with political figures across both parties. In the summer of 1929, Baruch systematically sold his stock holdings and moved into cash and gold. He later described his reasoning in his autobiography, saying that the market had simply gone too far and that common sense told him to get out. That explanation is plausible. It is also incomplete, because the timing of Baruch's exit was not common sense operating in the abstract. It was common sense operating with access to information and relationships that most Americans did not have. Joseph Kennedy, the patriarch of the Kennedy family, and at that point a successful stock operator with a reputation for aggressive and occasionally questionable trading tactics, has become the most famous example of pre-crash positioning, partly because the story attached to him is vivid enough to have survived as a piece of American folklore. Kennedy reportedly said that when a shoeshine boy on Wall Street started giving him stock tips, he knew it was time to sell. He sold. He also took short positions, bets that stocks would fall, that paid out substantially after the crash. Kennedy emerged from the Depression significantly wealthier than he had entered it. J.P. Morgan and Company, the most powerful private bank in the United States, had been quietly reducing its exposure to the equity markets through the spring and summer of 1929. The specific internal communications directing this reallocation have not survived or have not been made public, but the outcome is visible in the record. Morgan's principal partners suffered losses that were modest relative to the destruction experienced by ordinary investors and smaller institutions. None of this was illegal. That fact is important and cannot be overstated. In 1929, there was no Securities and Exchange Commission. There were no insider trading laws. There was no requirement that large investors disclose their positions or their trades. A man who sat on the board of a corporation, who had access to that company's internal financial information, and who sold his shares before bad news became public had broken no law. The legal architecture that would eventually prohibit these practices did not exist yet, and it did not exist precisely because the people who would have been regulated by such laws were the same people who held influence over the legislative process. What these exits represent, taken together, is not necessarily a conspiracy in the formal sense, not a meeting with minutes and a signed agreement. What they represent is something more structural, and in some ways more troubling. A class of people with superior access to information, superior access to the policymakers who controlled the conditions of the market, and the financial sophistication to act on both, doing exactly that at the exact moment when acting on it mattered most. The question that the official narrative never asked was straightforward. If the crash was genuinely unforeseeable, a random catastrophe produced by collective irrational exuberance, why did the people closest to the institutions that governed the financial system exit before it happened? There are several possible answers, and honesty requires acknowledging all of them. One answer is that sophisticated investors simply read the same publicly available data more carefully than ordinary investors, and drew correct conclusions. Valuations in 1929 were, by almost any reasonable metric, extreme. Price-to-earnings ratios on major stocks had reached levels that had no historical precedent. Credit used to purchase stocks on margin had expanded to a degree that made the market structurally fragile. A person who understood finance well enough could have seen this without any privileged information and made the rational decision to exit. A second answer is that some of these individuals did have access to information that was not publicly available, not through any formal conspiracy, but through the informal networks of relationship and communication that connected the senior figures of American finance and government in the 1920s. A phone call from a Federal Reserve official to a former colleague at a private bank, a dinner conversation in which someone who had attended the right meetings communicated, perhaps obliquely, that policy was about to tighten. These communications would leave no paper trail. They would not constitute a crime under the law of the time, but they would produce exactly the pattern we observe. Specific individuals connected to specific institutions, exiting the market in the specific window between the Fed's August rate increase and the October collapse. A third answer, which historians have increasingly taken seriously, focuses not on the crash itself but on what followed it. Because the crash, as devastating as it was, did not have to produce the depression. Markets crash, they recover. What converted the 1929 crash into a decade-long catastrophe was the subsequent destruction of the banking system, and that destruction was the direct consequence of Federal Reserve policy after October 1929, not before it. This is the argument that Milton Friedman and Anna Schwartz would spend years building from the ground up, and when they finally published it in 1963, it did not merely challenge the official narrative, it demolished it. But the evidence they used had been sitting in the Federal Reserve's own records the entire time. Milton Friedman did not set out to indict the Federal Reserve. He set out to understand money. In the late 1940s and through the 1950s, Friedman was building what would become the foundation of monetarist economics, the argument that the quantity of money in circulation was the primary driver of economic activity, and that controlling that quantity was the central responsibility of any serious monetary authority. It was rigorous technical work grounded in data rather than ideology. And as Friedman and his colleague Anna Schwartz worked backward through the historical record of American monetary policy, they kept arriving at the same period, the same institution, and the same sequence of decisions. The Federal Reserve, 1929 to 1933, and a money supply that shrank by nearly one-third. The book they published in 1963, A Monetary History of the United States, 1867-1960, ran to nearly 900 pages. It was not written for a general audience. It was written for economists, and it argued its case with the kind of documentary density that made it difficult to dismiss and nearly impossible to refute on its own terms. The core finding was stated with precision. The Federal Reserve, between 1929 and 1933, allowed and through specific policy choices actively contributed to a contraction of the money supply of approximately 30%. That number requires context to be fully understood. Money supply in a modern economy is not simply the physical currency in circulation. It includes the deposits held in banks, the credit extended through the banking system, the instruments through which businesses and individuals conduct transactions. When banks fail, deposits disappear. When deposits disappear, the money supply contracts. When the money supply contracts sharply, economic activity collapses, not because anything has changed in the physical world, not because factories have been destroyed or workers have forgotten how to do their jobs, but because the medium of exchange through which all economic activity is coordinated has been drained from the system. Friedman and Schwartz documented this process in precise chronological detail. They identified 3 specific waves of bank failures between 1930 and 1933. They showed that each wave was preceded by identifiable strains in the banking system that the Federal Reserve could observe in real time. They showed that in each case, the tools to respond were available. The Fed could have purchased government securities in the open market, injecting reserves into the banking system and providing the liquidity that would have allowed solvent banks to survive depositor runs. It had done this before under Benjamin Strong, and it had worked. It did not do this after Strong's death. The question Friedman and Schwartz asked was not rhetorical. They genuinely wanted to understand why. What they found in the Federal Reserve's internal records was a picture of institutional paralysis, but a very specific kind of paralysis, shaped by the ideas of the people who had filled the power vacuum left by Strong's death. Strong had believed, with the confidence of someone who had managed through the financial crises of 1907 and the First World War, that the Fed's primary responsibility was to maintain stability. If the banking system faced a liquidity crisis, the Fed should provide liquidity. This was not a radical position. It was the position of Walter Bagehot, the 19th century British economist who had articulated the lender of last resort doctrine that every serious central banker of the era claimed to understand. Lend freely, at penalty rates, against good collateral. Stop the panic, let the system recover. What replaced Strong's philosophy after 1928 was a coalition of voices that believed, with what Friedman and Schwartz described as a fundamental misunderstanding of monetary economics, that the Depression was a necessary purge. The excesses of the 1920s had to be liquidated. Intervening to prop up failed banks would only delay the adjustment and make it worse in the long run. This was the liquidationist doctrine, and it was held with genuine conviction by some of the most influential figures in American economic policymaking of that era. Andrew Mellon articulated it most bluntly, but he was not alone. Adolph Miller, a member of the Federal Reserve Board who had survived from the institution's earliest days, opposed open market operations throughout the crisis. George Harrison, who replaced Benjamin Strong as governor of the New York Fed, understood what needed to be done and repeatedly proposed it, and was overruled or blocked by the Washington Board. The internal correspondence that Friedman and Schwartz examined showed Harrison arguing for intervention, being denied, arguing again, being denied again, and eventually going along with a policy he privately believed was catastrophic. This internal record is important because it refutes the simplest exculpatory narrative, that the Fed simply did not understand what was happening. Some of the people inside the institution understood exactly what was happening. They were overruled by people who understood it differently and who held the institutional authority to make the decision. Friedman and Schwartz were careful about the language of intent. They did not argue that the Federal Reserve deliberately caused the depression in the sense of consciously pursuing that outcome as a goal. What they argued was something more specific and in some ways more damning, that the Federal Reserve failed to perform its most basic institutional function, that this failure was the result of specific policy choices made by specific individuals, and that those choices were not forced upon the institution by circumstances beyond its control. The tools existed, the authority existed, the precedents existed, the decision was made not to use them. The book's reception in 1963 was significant but slow. Academic economists engaged with it seriously and could not find fundamental errors in the data. The argument built over years. It was cited, debated, extended. Gradually, it became the dominant framework for understanding the depression among monetary economists. Not universal, not without critics, but the position that anyone writing seriously about 1929 to 1933 had to contend with. The general public remained largely unaware of it. This is partly a function of how academic economics works. A 900-page technical monograph does not reach the same audience as a newspaper editorial. The narrative that had been set in place by 1930, reckless speculation, natural correction, no one to blame, had 30 years of repetition behind it by the time Friedman and Schwartz published their challenge. School textbooks did not change overnight. Political speeches did not reference monetary contraction. The version of the Depression that lived in American cultural memory was still the version assembled in the immediate aftermath by the people who had the most to lose from a more accurate account. But there was one place where the Friedman-Schwartz argument eventually landed with full institutional force, and that was inside the Federal Reserve itself. In November 2002, at a conference held to celebrate Milton Friedman's 90th birthday, a Federal Reserve governor named Ben Bernanke delivered a short speech that contained a passage that had no precedent in the institution's public history. Bernanke had spent his academic career studying the Great Depression. He had read a monetary history with the attention of someone who intended to learn from it. And standing before Friedman at that conference, he said, on behalf of the Federal Reserve, "You're right, we did it, we're very sorry, and we won't do it again." The apology was genuine. It was also 70 years late. And it raised a question that Bernanke did not address that afternoon, one that the Friedman-Schwartz framework, for all its precision, had carefully sidestepped. If the Federal Reserve's failure was the mechanism that turned a crash into a depression, who benefited from that failure, and what happened to the assets that were liquidated at collapsed prices during the years the Fed refused to act? The liquidation of America did not happen in the dark. It happened in courthouses, in bank auctions, in foreclosure proceedings published in local newspapers, in the ordinary administrative machinery of a legal system processing an extraordinary volume of financial failure. The records exist. The transactions are documented. What has rarely been assembled is a clear picture of the directional flow, of where the assets went after they were stripped from the people who could no longer hold them. Between 1930 and 1933, American farmland changed hands at a scale that had no precedent in the country's history. The agricultural Midwest had entered the 1920s carrying significant debt, much of it taken on during the First World War when commodity prices were high and banks were aggressively expanding farm credit. When crop prices collapsed after the war and then again after 1929, millions of farmers found themselves holding mortgages they could not service on land that was worth less than what they owed. The foreclosure process was swift. A farmer who missed payments would receive notice. If he could not catch up, and in the early 1930s, catching up was nearly impossible because there was no credit available anywhere in the system, the bank would begin foreclosure proceedings. The land would be auctioned. In distressed markets with no buyers who had access to credit, the auction prices were frequently a fraction of the pre-crash valuation. Who attended those auctions with cash? Insurance companies, which held large reserves in liquid form and were not subject to the same runs as commercial banks, acquired farmland across multiple states at prices that bore almost no relationship to productive value. Large agricultural corporations expanded their holdings dramatically during this period. Investment trusts controlled by wealthy families, families like the Mellons, who held interests in banking, oil, and industrial production, were positioned to acquire real assets at liquidation prices precisely because they held cash when almost no one else did. This was not a secret at the time. Congressional investigators noticed it. In 1932, the Senate Banking Committee opened hearings into the practices of Wall Street banks and financial institutions in the years surrounding the crash. Those hearings, which ran through 1933 and 1934 under the Chief Counsel Ferdinand Pecora, produced thousands of pages of testimony and documentary evidence. The Pecora Commission, as it became known, remains one of the most significant financial investigations in American legislative history. What Pecora found was a financial system operating with a degree of self-dealing and insider advantage that shocked even the senators conducting the hearings, and the senators of 1932 were not naive about the relationship between money and power. He found that the partners of J.P. Morgan and Company had distributed shares in new stock offerings to a preferred list of clients, politicians, business leaders, prominent figures, at prices below what the public would pay when the stocks began trading. This practice, known as a preferred list, was not illegal. It was simply a mechanism by which the most powerful bank in America maintained relationships with the most powerful people in American political and business life by providing them with guaranteed profits at no risk. Among the names on Morgan's preferred list, Calvin Coolidge, the former president; William Gibbs McAdoo, a United States Senator; Owen Young, the chairman of General Electric. Pecora found that Charles Mitchell, the chairman of National City Bank, the largest commercial bank in the United States, had sold stock to family members at a loss in late 1929 specifically to eliminate his tax liability for that year, then repurchased the stock shortly afterward. He had paid no income tax in 1929 despite a personal compensation of more than $1 million. Mitchell resigned in disgrace, though he was ultimately acquitted on tax evasion charges at trial. He found that Goldman Sachs had created a series of investment trusts in 1929, layered structures in which one trust owned shares in another trust which owned shares in another trust, that amplified leverage to a degree that guaranteed catastrophic losses for retail investors when the market turned, while the people who designed and sold the trusts collected fees on the way in. These findings produced legislation. The Securities Act of 1933 required disclosure in public stock offerings. The Securities Exchange Act of 1934 created the Securities and Exchange Commission. The Glass-Steagall Act of 1933 separated commercial banking from investment banking, preventing the conflicts of interest that had allowed banks to simultaneously manage their clients' deposits and speculate with them. The Federal Deposit Insurance Corporation was created, guaranteeing bank deposits up to a specified limit and ending, in structural terms, the bank run as a feature of American financial life. These were genuine reforms, and they mattered. But the Pecora hearings also illustrated something about the limits of accountability in a system where the people being investigated were the same people whose cooperation was necessary to keep the financial system functioning. Mitchell faced scrutiny but escaped prison. The Morgan partners who had distributed preferred list shares faced no criminal charges. The Goldman Sachs executives who had constructed the leveraged trust structures that devastated retail investors were embarrassed in public testimony but not prosecuted. And the Federal Reserve, the institution whose specific policy decisions Friedman and Schwartz would later identify as the proximate cause of the Depression's depth and duration, was not called before the Pecora Commission to account for those decisions. Its internal deliberations remained private. The minutes of its board meetings were not entered into the congressional record. The men who had voted against open market operations while 9,000 banks failed answered to no congressional committee, faced no public examination of their reasoning, and in most cases continued in their careers without consequence. This gap between the accountability applied to private bankers and the immunity effectively extended to the public institution, whose failures were arguably more consequential, was not accidental. It reflected a political reality that shaped what the New Deal could and could not accomplish. Roosevelt needed the Federal Reserve to cooperate with his recovery programs. He needed the major banks to participate in his financial reforms. The price of that cooperation was a degree of institutional protection that kept the most fundamental questions about what had happened in 1929 to 1933 outside the boundaries of the official investigation. The people who had exited the market before the crash, Warburg, Baruch, Kennedy, Morgan, were not subpoenaed to explain their timing. The question of whether their exits reflected access to information about Federal Reserve policy that was not available to the public was never formally asked in a setting with legal authority to compel an answer. That question has never been formally asked in any such setting. What remained after the Pecora hearings, after the New Deal legislation, after the institutional reforms of 1933 and 1934, was a historical record that documented the symptoms of the crisis in considerable detail while leaving the deepest structural questions about its causes intact. Questions about the relationship between public monetary authority and private financial power, about who held information and when, about the direction in which assets moved during the liquidation that the Fed's passivity made possible. Those questions did not disappear. They went underground into the academic literature, into the archives, into the work of researchers who were operating far from the public narrative. And they would stay there until the next time the system broke. Andrew Mellon left the Treasury Department in February 1932 under circumstances that were, by the standards of American political life, remarkable. He had served as Treasury Secretary for 11 years under 3 presidents, Harding, Coolidge, and Hoover. He was, by some measures, the most powerful financial official in the country for most of the 1920s. His tenure at Treasury had coincided with the greatest peacetime economic expansion in American history, and he had taken substantial personal credit for it, arguing that his program of tax cuts for high earners had unleashed the productive capacity of American business. When the Depression came, and when his liquidationist prescriptions failed to produce recovery, Hoover moved him sideways, appointing him ambassador to Britain, a prestigious posting that functioned as a removal from the scene. What followed Mellon's departure was a congressional investigation that went places American institutional politics rarely go. In 1934, the Internal Revenue Service, acting on a referral from the Roosevelt administration, accused Mellon of tax fraud for the years 1931 and 1932. The specific allegation was that Mellon had used a series of art donations and transactions to reduce his tax liability in ways that did not comply with the law. Mellon denied the charges. The case went before the Board of Tax Appeals, a predecessor to the modern tax court, and ran for years. The case is worth examining not primarily for what it established about Mellon's taxes, which were ultimately resolved in his favor, but for what the investigation revealed about the structure of his financial holdings during the Depression years. Mellon's personal fortune, which had been built over decades in banking, aluminum, and oil, had not been destroyed by the crash and the Depression. It had been partially restructured. His holdings in the Aluminum Company of America, Alcoa, had been maintained. His interests in Gulf Oil had been maintained. The Mellon Bank, which he had founded, had survived the wave of bank failures that destroyed thousands of smaller institutions, in part because of his access to resources and relationships that community banks did not have. This pattern of survival among the largest and most connected financial institutions, while smaller competitors were liquidated, was not coincidental. It was the direct consequence of the Federal Reserve's selective intervention during the crisis, because the Fed, even in its period of greatest passivity, was not entirely inactive. It made choices about which institutions to support and which to allow to fail. The historical record on this point requires careful framing. It would be inaccurate to say that the Federal Reserve deliberately preserved specific wealthy families while liquidating the middle class. The evidence does not support that precise claim. What the evidence does support is something structurally similar in its effects. The institutions that were large enough, connected enough, and liquid enough to survive the crisis without Fed intervention did so, while the institutions that required intervention to survive, the small and mid-sized banks serving ordinary depositors in rural and industrial communities, received none. The result, regardless of intent, was a massive transfer of financial and real assets from the bottom and middle of the American wealth distribution toward the top. Economists Thomas Piketty and Emmanuel Saez, working with tax records that became available in the early 2000s, documented what happened to American income and wealth distribution during the Depression. Their data showed that the share of national income held by the top 1%, which had reached approximately 24% by 1928, declined during the Depression, but that this decline was primarily a function of reduced capital income as asset prices fell. The underlying ownership of productive assets, land, industrial capacity, corporate equity, did not redistribute downward in any meaningful way during the 1930s. What redistributed was the surface layer of financial paper, the stock certificates and bond holdings that had been widely distributed among middle-class investors during the 1920s. When those certificates became worthless, the middle-class investors lost what they had put in. The real assets that backed those financial instruments, the factories, the farmland, the mineral rights, remained in the hands of the institutions and families that had held them before the crash, and in many cases expanded. This is the mechanism that the official narrative of irrational speculation and collective greed obscures. The narrative focuses on the destruction of paper wealth, which was real and devastating for the people who experienced it. What it does not focus on is the simultaneous consolidation of real wealth that occurred during the same period, a consolidation made possible by the combination of Federal Reserve passivity, which deepened and extended the crisis, and the absence of legal frameworks that might have restrained the acquisition of distressed assets at below-market prices. Ferdinand Pecora understood this. His hearings had circled the edges of it. But the political constraints of the New Deal period, the need to rebuild confidence in the banking system, the need to work with the financial institutions that survived the crisis, the need to maintain the cooperation of the Federal Reserve, made a full accounting politically impossible. Roosevelt himself was clear-eyed about the contradiction. In his 1936 re-election campaign, he delivered a speech in Madison Square Garden that contained some of the most direct language about financial power ever spoken by an American president. He spoke of organized money, of the forces of selfishness and lust for power, of an economic royalty that had concentrated control over other people's money and other people's lives into their own hands. He said these forces were unanimous in their hatred of him, and that he welcomed their hatred. The crowd roared. But the Glass-Steagall separation of commercial and investment banking, the most structurally significant reform of the New Deal period, did not break up the major financial institutions. It regulated them. The Morgan Bank divided into commercial and investment arms, J.P. Morgan and Morgan Stanley, but the underlying capital and relationships survived. The Mellon interests survived. The Rockefeller financial network survived. What had been destroyed was the independent banking system that had served ordinary Americans in thousands of communities across the country. 9,000 banks, gone, replaced gradually by a more concentrated system in which the surviving major institutions occupied a larger share of the market than they had held before the crisis. Concentration, in other words, was the outcome of the depression for American banking, not dispersion, not democratization, concentration. The Federal Reserve had not caused this concentration in the sense of pursuing it as a deliberate objective, but its policy choices, the decision to withhold liquidity, to allow the wave of bank failures to proceed, to embrace the liquidationist doctrine, had produced it as a consequence. And the people who held the institutional authority to make those policy choices had personal and professional relationships with the institutions that stood to benefit from consolidation. Whether that relationship constituted a conflict of interest in the formal sense is a question that was never examined by any official body with the authority and the will to pursue it to its conclusion. The closest the country came to that examination was a set of documents that sat in Federal Reserve archives for decades after the crisis ended, documents that detailed, in the precise bureaucratic language of central banking, exactly what the institution had known, when it had known it, and what it had chosen to do. Those documents would eventually be read by a young economist who would spend the better part of 30 years studying them, drawing conclusions from them, and ultimately sitting in the chair of the man most responsible for the decisions they described. His name was Ben Bernanke, and what he did with what he learned from those documents would define the response to the next great financial crisis and raise in a new context all the same questions about who gets protected when the system breaks. Ben Bernanke arrived at Princeton in 1985 with a specific research agenda. He wanted to understand why the Great Depression was so severe, not the crash. The crash had been studied extensively. What Bernanke wanted to understand was the transmission mechanism, the precise channel through which a financial crisis in 1929 and 1930 produced the economic devastation of 1932 and 1933. Friedman and Schwartz had identified monetary contraction as the primary driver. Bernanke believed they were right but incomplete. There was something else happening in the destruction of the banking system, something beyond the simple arithmetic of money supply that made the depression as deep and as long as it was. What he identified in a series of papers that began appearing in the mid-1980s was what he called the credit channel. The argument was precise. Banks do not simply hold deposits and make loans in a mechanical way. They hold information. A community bank that has been lending to the same farmers and small businesses for 20 years has accumulated specific, non-transferable knowledge about those borrowers, their reliability, their collateral, their seasonal cash flow patterns, their character. This knowledge cannot be easily replicated by a distant institution that has never dealt with them. When that community bank fails, this accumulated information is destroyed along with it. The credit relationships it supported cannot be instantly rebuilt by a surviving institution moving into the market. They have to be reconstructed from scratch over years at significant cost. Multiply this by 9,000 bank failures, spread across every agricultural and industrial community in the country, and what you get is not simply a contraction in the money supply. You get the destruction of the informational infrastructure of credit, the invisible network of knowledge and relationship through which productive economic activity is financed. Rebuilding that network takes time that money alone cannot buy. This was Bernanke's contribution to Depression economics, and it was important. But what made it consequential beyond the academic literature was what Bernanke did with it when he left Princeton and entered public life. He joined the Federal Reserve Board of Governors in 2002. He became chairman in 2006, and he brought with him a scholar's precise understanding of what the Federal Reserve had done wrong between 1929 and 1933, and what it should have done instead. The speech he delivered at Friedman's 90th birthday conference in November 2002 was short, and its most important passage was delivered with the dry understatement of an academic addressing a colleague rather than the rhetorical weight of a public official making a historical admission. But the words were unambiguous. Regarding the Great Depression, Bernanke said, "On behalf of the Federal Reserve, we did it, we're very sorry, and we won't do it again." The significance of that statement requires unpacking. A sitting Federal Reserve governor, speaking in his official capacity, had just confirmed in plain language that the institution he represented had caused the worst economic catastrophe in American history. Not contributed to it, not failed to prevent it, caused it. The Friedman-Schwartz argument that the Federal Reserve's active policy choices had converted a severe recession into a decade-long depression had been formally accepted by the institution itself. This acknowledgement had been building for years inside the Fed's internal culture. The institution had spent decades absorbing the Friedman-Schwartz critique, processing it through successive generations of economists and governors, and gradually arriving at the position that Bernanke stated publicly in 2002. But stating it publicly in those terms was still a significant act. It foreclosed certain defenses. It established an institutional commitment, we won't do it again, that carried operational weight. 6 years later, that commitment was tested. When Lehman Brothers filed for bankruptcy on September 15, 2008, and the global financial system began its most acute crisis since 1929, Bernanke was sitting in the chairman's seat. What he did in the weeks and months that followed was shaped, at every decision point, by his understanding of what the Federal Reserve had failed to do in 1930 and 1931. He provided liquidity, massively, immediately, and without the ideological hesitation that had paralyzed the Fed under the liquidationist faction. He opened lending facilities that had never been used at that scale. He coordinated with the Treasury Department and with central banks around the world. He kept the major financial institutions alive. The recession of 2008 and 2009 was severe. Unemployment reached 10%. Millions of people lost their homes. The human cost was real and substantial, but it did not become the Great Depression. The banking system did not collapse. 9,000 banks did not fail. The money supply did not contract by 30%. The credit channel was damaged but not destroyed in the way it had been destroyed between 1930 and 1933. By the metric Bernanke had set for himself, we won't do it again, he succeeded. But the 2008 response also reproduced, in a new context, the structural pattern that the Depression era had established. The institutions that were saved were the largest ones: Bear Stearns, AIG, Citigroup, Bank of America. The mechanism of salvation was the transfer of risk from private balance sheets to the public balance sheet, through guarantees, through purchases of distressed assets, through lending at terms unavailable to any private actor. The people who had made the decisions that produced the crisis, the executives who had constructed and sold the mortgage-backed securities, who had built the leverage that made the system fragile, who had collected the fees and bonuses while the risk accumulated, were not, with a small number of exceptions, held criminally accountable. One significant prosecution emerged from the entire financial crisis. Karim Sarageldin, a Credit Suisse trader, was sentenced to 30 months in prison in 2013 for his role in concealing losses in a mortgage bond portfolio. He was, by most accounts of people who followed the case, a mid-level figure whose conduct was representative of practices that were widespread across the industry. He was also, notably, the only person sentenced to prison for conduct directly related to the financial crisis that cost the global economy an estimated $10 trillion. The pattern that had characterized the Depression response repeated itself. The reforms were real. Dodd-Frank imposed new regulatory requirements on large financial institutions, created a Consumer Protection Bureau, established mechanisms for resolving failing banks without public bailouts. But the major institutions survived. They emerged from the crisis, after the government support, larger and more concentrated than they had been before it. The community banking sector, which had been losing ground to large institutions for decades, continued to shrink. Concentration again was the outcome. The Federal Reserve's response to 2008 was not the moral equivalent of its response to 1929. That comparison is not accurate and should not be made. Bernanke's Fed acted where the 1930s Fed had refused to act. The consequences were different because the actions were different. But the question of who gets protected, which institutions, which creditors, which class of financial actors, was answered in 2008 in ways that closely echoed how it had been answered by the liquidation of the 1930s, just with the direction of the transfer reversed. In the 1930s, the Fed's inaction allowed assets to flow from ordinary Americans toward the largest institutions. In 2008, the Fed's action prevented losses from flowing from the largest institutions toward the people who owned them. The middle class in both cases absorbed the cost of the adjustment. This parallel was not lost on the people who lived through 2008 and who had enough historical knowledge to draw the comparison. It produced a political reaction that fed into movements on both the left and the right. The Occupy protests, the Tea Party, and eventually the broader populist currents that reshaped American politics in the decade that followed. The specific monetary mechanisms were too technical for most political discourse to engage with directly, but the felt sense of the pattern, that the rules were different for large financial institutions than for everyone else, that crises produced consolidation rather than accountability, that the people responsible for failures were protected while the costs were distributed widely, that felt sense was accurate. It was accurate because the pattern was real. And the pattern was real because the institutional architecture that made it possible, a central bank with enormous discretionary power, operating with limited transparency, whose decisions about who to rescue and who to allow to fail carried consequences that dwarfed any other policy instrument in the government's hands, had been built into the American financial system in 1913, stress-tested to catastrophic failure between 1929 and 1933, and rebuilt without the fundamental structural reforms that might have changed who it served. The Federal Reserve's 2002 acknowledgement that it had caused the Depression was honest. It was also, in an important sense, incomplete, because the full acknowledgement would have required not just admitting what the Fed had done wrong technically, the failure to maintain the money supply, the refusal to act as lender of last resort, but engaging with the question of who benefited from that failure and whether the institutional relationships that shaped the policy choices of 1929 to 1933 had any structural analog in the institution as it existed in 2002. That question was not asked in the Friedman birthday speech. It has not been asked in any formal setting with the authority to compel an answer since. There is a document in the National Archives that most Americans have never heard of. It is not classified. It has not been suppressed. It sits in the public record, accessible to anyone with the patience to request it and the background to understand what they are reading. It is a transcript of the Federal Reserve Board's meeting of August 9, 1929. 7 weeks before the Dow reached its peak, 11 weeks before Black Thursday, in which the members of the board discussed the state of the credit markets, the level of stock market speculation, and the question of whether to raise the discount rate further. The discussion is technical, measured, and written in the careful language of men who understood that their words were being recorded. But reading it with the knowledge of what followed, certain passages carry a weight that the participants may or may not have intended. The board was aware that credit conditions were stretched. It was aware that stock market valuations had reached levels that several members privately considered unsustainable. It was aware that the policy of moral suasion, the attempt to discourage speculative lending through public statements rather than rate increases, had not worked. And it was aware, because Benjamin Strong had spent years building the case, that the Federal Reserve's primary responsibility in a credit crisis was to act as a stabilizing force, not a neutral observer. Strong had been dead for 10 months when that meeting was held. What the transcript shows is not a conspiracy. It shows something more mundane and in some ways more troubling, a group of institutional actors operating within a framework of ideas that had shifted, making decisions that seemed reasonable within that framework without adequate consideration of the consequences that would flow from those decisions for the millions of people outside the room whose lives depended on getting them right. That is not a story unique to 1929. It is a story about how institutional power operates in every era, through the normal functioning of normal processes, inside rooms where the people making decisions are insulated from the direct consequences of making them badly. The specific history of the Federal Reserve in the Great Depression matters not because it is the worst example of this dynamic in American history. It may not be, but because it is one of the most thoroughly documented, most rigorously analyzed, and most formally acknowledged. Bernanke's 2002 statement was not a slip. It was the conclusion of a process in which the institution examined its own past with enough honesty to arrive at an uncomfortable verdict. That is genuinely unusual. Most institutions do not do it. But acknowledgement and accountability are different things. The Federal Reserve acknowledged what it had done. No one was held accountable for it. The men who voted against open market operations while 9,000 banks failed, who sat in that room and chose, repeatedly, not to act, faced no legal consequence, no professional sanction, no formal judgment beyond the verdict of history. Most of them died in comfortable circumstances. The institutional culture that produced their decisions was reformed, but not in ways that fundamentally restructured the relationship between the Fed's discretionary authority and the public interest it was supposed to serve. The reforms of the New Deal period were significant. Glass-Steagall mattered, the SEC mattered, federal deposit insurance mattered. These were structural changes that genuinely reduced the fragility of the system and protected ordinary depositors in ways that had not existed before the Depression. The people who designed and fought for these reforms, Pecora, Roosevelt, Senator Carter Glass, Representative Henry Steagall, deserve the credit history has given them. But the question that Glass-Steagall and the SEC and deposit insurance did not address was the question of monetary policy itself, of who held the authority to decide when to expand and when to contract the money supply, of how those decisions were made, of what interests shaped them, and of what accountability existed when they were made badly. That question was addressed by the Banking Act of 1935, which reorganized the Federal Reserve's governance structure, moving power from the regional Federal Reserve banks toward the Washington-based Board of Governors. This was presented as a democratizing reform, reducing the influence of the New York banking community over monetary policy, and in formal structural terms it was. But the Board of Governors was still an appointed body, insulated from electoral accountability, operating with a degree of discretionary authority that exceeded almost any other institution in the federal government. The Federal Reserve in 2026 operates under a governance structure that is substantially similar to the one created in 1935. Its independence from direct political control is defended by economists across the ideological spectrum as essential to its effectiveness. The argument is that a central bank subject to short-term political pressure will inflate the currency to finance government spending or to boost employment before elections, sacrificing long-term price stability for short-term political gain. This argument has genuine merit. The history of politically controlled central banks in other countries provides real evidence for it. But independence is not the same as accountability, and the history of the Federal Reserve between 1929 and 1933 demonstrates, with the precision of a controlled experiment, what happens when an institution with enormous discretionary power over the economy operates without meaningful accountability for the consequences of its decisions. 9,000 banks failed. A quarter of the workforce lost their jobs. The money supply contracted by 30% over 4 years, while the institution responsible for maintaining it held meetings, wrote memos, and declined to act. And the assets that were liquidated during those 4 years, the farms, the businesses, the homes, the industrial capacity, moved through the ordinary functioning of contract law and financial markets, from the people who could not hold them to the people who could. The people who could hold them were, with notable exceptions, the people who had been positioned before the crisis. The people who had exited the market in the summer of 1929, the people with access to the networks of information and relationship that connected private finance and public monetary authority, the people whose institutions survived because they were large enough and connected enough not to need the intervention that the Fed withheld from everyone else. This is not a conspiracy theory. Conspiracy theories require intent, coordination, and concealment operating at a scale that strains credibility. What the historical record of 1929 to 1933 shows is not a conspiracy. It shows a system operating as systems operate, distributing outcomes according to the distribution of power, information, and relationship within it without any individual actor necessarily intending the aggregate result. That distinction matters because conspiracy theories are easy to dismiss, and dismissing them allows the underlying structural questions to remain unasked. The structural questions are harder. They require engaging with the specific mechanisms through which institutional power shapes policy outcomes, with the specific ways in which the people inside powerful institutions come to hold the ideas they hold and maintain the relationships they maintain, and with the specific gap between the public purposes those institutions claim to serve and the actual distribution of consequences when they fail. Those questions do not have clean answers. They do not resolve into a single villain or a single moment of revealed truth. They resolve into a pattern that has repeated itself across American financial history, with enough consistency to be taken seriously as a feature of the system rather than an anomaly within it. Milton Friedman spent his career arguing that the Federal Reserve's errors between 1929 and 1933 were genuine errors, mistakes born of bad theory and institutional dysfunction, not malice. He was almost certainly right about that. But genuine errors made by powerful institutions still have beneficiaries. The error of withholding liquidity still liquidated 9,000 banks. The assets from those banks still went somewhere. The wealth that was destroyed in the middle of the American economy still had to be rebuilt from scratch by the people who lost it over decades, while the wealth that was preserved at the top of the economy continued compounding. Friedman's framework explains what happened. It does not fully account for who paid. Ben Bernanke's framework explains what should have been done differently. It does not fully account for why the people who could have done it differently chose not to, or for the relationship between their institutional positions, their personal networks, and the policy choices they made. Ferdinand Pecora's hearings documented what the financial system had done to ordinary Americans. They did not produce criminal accountability for the people most responsible. Franklin Roosevelt spoke with genuine anger about economic royalty and organized money. He also worked with the surviving institutions of organized money to rebuild the system, because there was no other way to rebuild it. Every honest accounting of the Great Depression arrives at this same set of unresolved tensions, between what can be proven and what can only be inferred, between structural explanation and individual accountability, between the reforms that were possible and the reforms that would have been necessary to change the underlying distribution of power. These tensions have not been resolved. They have been inherited. The Federal Reserve today is a more transparent institution than it was in 1929. Its policy decisions are communicated through press conferences, published minutes, and detailed speeches. Its research is public. Its governors testify before Congress regularly. These are genuine improvements over the opacity that characterized the institution in the Depression era. But the fundamental structure remains, an institution with discretionary authority over the money supply, making decisions that affect every American, accountable primarily to its own internal culture and to the political appointment process, operating within a set of institutional relationships that connect it to the financial sector it regulates in ways that have never been fully mapped or fully examined. The shoeshine boy who gave Joseph Kennedy a stock tip in 1929 had no way of knowing that the man he was talking to had already sold. He had no way of knowing that the institutions most capable of reading what was coming were already positioned for it. He had no way of knowing that the Federal Reserve, the institution created specifically to protect the system he had put his savings into, had made policy choices that would make everything worse. He found out in October. What he could not know, what took economists 30 years to prove, and what the institution itself took 70 years to formally acknowledge, was that what happened to him was not an accident. It was not fate. It was not the natural consequence of his own irrational exuberance. It was the consequence of specific decisions made by specific people in specific rooms, decisions that were shaped by specific interests and specific relationships, decisions that produced specific outcomes for specific classes of people, outcomes that were distributed as outcomes always are according to the distribution of power that existed before the crisis began. That distribution of power has changed since 1929. The reforms of the New Deal changed it. The post-war expansion changed it. The growth of the American middle class in the decades after the Second World War changed it in ways that genuinely reduced the concentration of the 1920s. And then, beginning in the 1980s, that concentration began to rebuild. By 2008, the share of national income held by the top 1% had returned to levels not seen since 1929. That number is not a coincidence. It is a measurement. It measures the distance between the system as it was designed on paper and the system as it has operated in practice, across a century, through multiple crises, through genuine reforms and genuine failures, through the acknowledgments that were made and the accountabilities that were not. The Federal Reserve did it. They were very sorry. They said they would not do it again. What they did not say, what no official institution has ever formally said, is who benefited when they did. That answer exists in the record. It has always existed in the record. It is waiting for someone with the authority and the will to ask the question out loud. This script is based on documented historical events, published academic research, declassified Federal Reserve records, congressional testimony from the Pecora Commission, and peer-reviewed economic literature including Friedman and Schwartz's A Monetary History of the United States, 1963. The exits of Warburg, Baruch, Kennedy, and Morgan from equity markets prior to the 1929 crash are documented in contemporary sources and historical accounts. The question of whether these exits reflected access to non-public information about Federal Reserve policy has not been formally investigated by any body with legal authority to compel testimony. All characterizations of institutional decision-making reflect the scholarly consensus on Federal Reserve policy from 1929 to 1933 as documented in the academic literature. Where historical uncertainty exists, it has been identified as such.